Things are getting very serious on our course now, because now we are talking about very important aspects or very important concepts in forex trading. And one of those concepts which we're going to be talking about today is 3 types of forex chart. So in forex trading we have 3 types of chart, and which one can you be able to use to better maximize your profits when it comes to forex trading? So that is what we're going to be covering on today's video. Hello everyone and welcome to my channel. My name is Golof. On this channel we talk everything about trading, business, personal finance and tips to help you stay profitable as a forex trader. So if this is your first time coming to my channel, please hit the subscribe button below to subscribe to the channel so that you can always be updated when I come up with content like this. What are we going to be covering on today's video? What we have on today's video is very simple. We're going to be talking about the 3 types of charts in forex trading. Let's just see what we have on our table of content. So on our table of content, we're going to be covering something like what is a price chart, because before we even talk about the 3 different types of charts we have in forex, we have to be talking about what is a price chart. So we shall cover that on today's video. We shall under what is a price chart. We shall cover what does a price chart represent. We shall also cover that in detail. Then types of price chart, because when it comes to price chart we have number 1, we have a line chart, a bar chart and a candlestick chart. And then the way forward, how can you be able to combine all these 3 charts to better maximize your profit as a forex trader? Trust me, you can't neglect this. You can't ignore this concept. Just as I informed you guys on my previous videos, all the videos on this course are linked. There is no way you're going to skip any video, or there is no way you're going to say, no, this video is not important, I want to just go straight to this one straight. No, all the videos are linked, and by the end of this video, trust me, if you watch to the end, you will see that this concept is one of the most important aspects which has been missing on your trading. So without taking much of your time, let's go to what is a price chart. If you can see here, they say a price chart is a graphical, all right, a graphical or a virtual, because this is very important, because you can see what we have here. What we have here is a price chart. This is a price chart. The whole of this is a price chart, all right? But when you open your MT4 or your MT5 and you see this and you see this, what does it represent? So they say a price chart is a graphical. You can see it's a graphical or a virtual representation of different currency prices over a specific period of time. As easy as that. So that is just a definition of a price chart. Anytime you see somebody talking of the chart of USD, JPY, chart of gold, chart of silver. So a chart is just a graphical or a virtual representation of different currency prices over a specific period of time. Because remember, here we're talking about forex. If we're talking about stocks, then it was going to be a visual or a graphical representation of stock prices over a specific period of time. But now we are talking about forex, so it is a visual or a graphical representation of different currency prices over a specific period. Because in forex we might be talking of the 4-hour time frame, the daily time frame, the monthly time frame, the weekly time frame, or even the yearly time frame. So the specific period is very important. If you want to take keyword from this definition, we have graphical, visual representation and specific keyword. Those are the specific period. Those are the most important keyword you have to take from this definition. And also on our definition, it represents trends and market technicals, because on your chart, when you go on any forex market chart or on any technical chart or any chart you're talking about, it represents trends or market technicals. All right, so any forex chart you think about will represent these few things. It will represent the trend and it will also represent the market technical. It is on your market chart, it is on your chart that you start determining your support and resistance, your trend lines, and all those other very juicy aspects which you need in your trading. And also the x-axis, if you check on your screen, let me just explain this so that you can better understand. If you check on your screen, they say the y-axis or the vertical axis, all right? This section of your graph stands for the y-axis. So on your screen, the y-axis represents the exchange rate, and the x-axis or the horizontal line represent the period or time scale. All right. So anytime you see any forex chart, anytime you see this section, you can see some digit. We have some digit here like 1.44, 1 point this. So this is equal to the exchange rate. All right. This is the exchange rate of that particular currency, in relation, or that particular currency in relation to other currencies. Why? What we have down here is the time. You can see here we have feed mark. So this is the time. Down here we have the time, and up here this the vertical axis stands for the exchange rate, and the horizontal axis stands for the time. Those are just few things you have to pick up when it comes to any chart, when it comes to any price chart. Just know that the horizontal level represents the time. If we're talking of the 4-hour time frame, then maybe you have 1 o'clock there, 1 o'clock, 4 o'clock, 6 o'clock, 8 o'clock. Maybe we're talking about 5-minute time frame. You have maybe 5 minutes, 10 minutes, 15 minutes, 20 minutes down here. Then as the exchange rate will be changing, you'll be seeing everything on this other end of the screen. And on the further end of the screen, that will represent the current price. All right. So this candle here, this price here, if you check, this price here will represent the current price, the CP. At the extreme end of the screen, that represents the current price of that particular currency in relation to other currencies. All right. So let's see what we have. So here, let's talk about another very important issue. All right. So what does a price chart represent? Okay, so now we're talking about what does a price chart represent, because here you say they say basically or preliminary, a price chart depicts or represents changes in the supply and demand of a currency in relation to other currencies. As simple as that. All right. Anytime you open your price chart and you see something, like you see the price going up and down like this, you see the price going up and down. The highest thing, the number one thing, basically or preliminary, what is being represented on that screen is demand and supply of that particular base currency in relation to other currencies. As simple as that. Anytime you open your chart, if the chart is going up and down, what is being depicted or what is represented on the screen is the demand and supply of that particular currency in relation to other currencies. Let me explain what I'm saying. Maybe it will make sense if I'm able to take a specific currency. Let's take this chart. The chart we have here is the United States Japanese yen. All right. So we have two currencies involved. We have the United States dollar and we have the Japanese yen. Those are two currencies. Those are two countries. Those are two economies involved. Those are two economies represented on this particular chart or on this particular board. All right. Sorry. So now let's take the United States as our base currency, because remember I said here we have USD JPY. All right. We've already spoken about our base currency, second currency. So the first or the base currency here is the United States dollar, and the secondary currency is the Japanese yen. So any decision that is being taken on this chart is in relation to the base currency. Is in relation to what? To the United States dollar. All right, let me explain the concept of demand and supply that I said. Any other action that is taking place on this chart represent the demand and supply, or represent the demand and supply of that particular base currency. All right, let's start with the United States dollar. Let's take a situation where the supply for the United States dollar is more than the demand for the United States dollar. All right. So the supply for the United States dollar just stands for the printing. You can also call it quantitative easing. All right. In economics, they call it quantitative easing, where they print a lot of money. All right. So let's just say in the United States dollar, they are printing a lot of dollars. So the supply of the United States dollar is more than the demand of the United States dollar by other economies. So maybe let's just take maybe the Japan or UK or Europe or whatsoever country. The demand for the United States dollar is lower than the supply. What will happen in any situation in economics or even in the society? Any situation where the supply is more than the demand, what happens? There will be dumping. If we're talking of good, then we'll talk of commodity dumping. That means they'll be dumping. They'll produce a lot in such a way that people can buy. The demand is more than the supply. But now we are talking about a currency. So in situation where they produce or they print money more than what people want or more than what other economies want that particular currency, what will happen? What will happen is what we call currency dumping. And when there's currency dumping, what happened? The price will reduce. All right, as simple as that. When there's currency dumping, the price of that particular currency in relation to other currencies will reduce. So if we're taking something like the United States dollar, in a situation where supply is greater than demand, all right, in a situation where supply is greater than demand, what will happen? The price of the United States dollar will drop in relation to other currencies. So in this case here, you see the chart will actually be going down. So if we're taking demand, so this area could be covered, because from year to year you can see the chart was actually going down. All right, from this area to this area, it was actually going down from year to year. So in this area, you can see this is the area where the supply of this currency was more than the demand. So the United States dollar encounter what we call currency dumping. There are other factors that can cause the currency the exchange rate to either go down. But all these currencies will either cause the demand for that currency to be high, or the supply for that currency to be high, or the demand. So all the other factors will either support the demand and the supply for that particular currency, be it news, be it fundamental, be it political or economics or geographical. They will either support the demand and supply for that particular currency. Anytime you look at your chart, those are the two factors. That is what is happening. If your chart is going up and down, what is behind, the fundamentals that are behind pushing the currency to either be high or low, is the demand and supply for that particular currency. I was taking a situation where if the supply for the United States dollar is more than the demand. Okay, now let's take for a situation where people see that, okay, the United States economy is very strong, and now they want the United States dollar. People from South Africa want the United States dollar. People from China want to do more business in the US because they want to use the United States dollar. People in the UK want it. So many economies, many people, even individuals, they want to have the United States dollar in their disposal. So in that situation, what will happen? The demand will be more than the supply. All right. So in any situation where the supply is instead less than the demand, if the supply is instead less than the demand, if the supply is less than the demand, what will happen? What we call scarcity. All right. There's what we call scarcity. So even in normal good or in normal economics or even in our society, anytime where the demand for any particular good is more than, or the supply for any particular good is less than the demand, they will cause what they call scarcity. And when there's scarcity, what happens? When there's scarcity, the price of that particular commodity will increase. In our situation, if the United States dollar is scarce, what will happen? The exchange rate will increase, or the price of the United States dollar in relation to other currency will increase. So that's why from year to year, from this other area, from year to year, this is when supply was more than demand. All right, from year to year, when the market was actually going down from year to year, this is when the supply of the United States dollar was more than the demand of the United States dollar currency. But from year to year, you can see the market has been going up. From year to year, the market has been in a consistent uptrend. All right, so since the market has been in an uptrend why? Because the supply now was less than the demand, causing what we call scarcity. And when there's scarcity, what happened? The price increases. All right, when there's scarcity at any point in time, the price increases. And now when there's dumping of any particular commodity, or when there's dumping of any particular currency, the price will normally reduce. All right, so that is just the concept behind any price chart you see. Any currency pair you open or any price you up, they follow the same scenario, they follow the same system. All right, so without taking much of your time, let's see what we have here. Okay, types of price chart, because we've spoken about what I was explaining to you is now it was the anatomy of any price chart you see. Those are the few things you see on it. But in Forex, we have three types of price chart. We have what we call the line chart. The line chart, as the name goes, is just a graphical representation. We have a line chart. We also have a bar chart, and we have a candlestick chart. So those are the three types of chart we have. We have a bar chart, a line chart, a bar chart, and a candlestick chart. So those are the three charts. We'll go detailing when we move forward on the video. I'll be able to explain to you guys in detail what each of these charts represent. All right. Before we even go to the first type of chart, please leave a thumb up on the video. If you are still here with me, please leave a thumb up on the video so that we can help another person get this free information. Because the more thumb ups we have on this video, the more many people are going to be able to be aware and also follow and get this free and very valuable information. And if you haven't subscribed, also remember to subscribe to the channel. All right. So the first type of chart we have here, let's see, the first type of chart we have here is a line chart. And what is a line chart? As simple as it is, a line chart, it shows the price movement of a currency over a period of time. As simple as that. A line chart just shows the price. It shows the price movement of a currency over a period of time. All right, so it shows it over a period of time. So they just plot it. If it's a line chart and you open your MT4 or your MT5, you just see something like this. You just see your graph. So the most important thing, what is lacking now is you don't know, you won't know the open, the close, the high and the low of each particular period. You won't know when the market opened, you won't know when the market closed, you won't know the highest price that was recorded in the market, and you won't know the lowest price that was recorded in the market for that period of time. So that is why a line chart is very inefficient. It's very inefficient when it comes to trading because it doesn't give you the details. After the line chart, we have what we call the bar chart. All right, the bar chart is when things start getting interesting, because with the bar chart you can even see we have some things on red. They say it shows the opening and the closing. All right, because the line chart, with the line chart, you won't be able to know the opening and the closing of that particular currency, or you won't be able to know the opening and closing of that particular interval or that particular period of time which you want to be able to measure the price. All right, but now if you come down to a bar chart, it shows the opening and the closing prices, as well as the high and the lows. You see, as well as the highs and the low of a currency within a period of time. So you see now, when we start moving from a line chart to a bar chart, the bar chart starts revealing more details, because with the bar chart now we are able to know the opening and the closing of that particular currency. We are also able to know the high and the lows of that particular currency, as opposed to a line chart. A line chart won't be able to give us all that information. So when it comes to a bar chart is just something like this. If you can see on my screen, you will see each bar represents a particular period. All right, each bar, you can see here we have a bar, here we have a bar. So each bar represents a particular period. Mark that down and take this very seriously. Each bar you see on my screen represents a particular period. So if we are talking of, let's just say we are talking of a 4-hour time frame, because here, okay, this one is a 4-hour time frame. So remember, I already mentioned whether it is a bar chart, a candlestick chart, or a line chart. Horizontally, you have the time period or the time scale. Horizontally, the time scale will be represented, and on the vertical scale, the currency price or the exchange rate will be represented. But now, with the bar chart, each of these bar represent 4 things. Each of these bar, you can see there are many bars here. That's why it is called the bar chart. And each of these bar you are seeing has 4 important things which you have to take into consideration. All right, the first thing you have to take into consideration is the open price. All right, the first thing you have to take into consideration is the open price of that particular bar. So what price the open price just stands for the price where the market, or the price that particular currency started trading. All right, at that particular period. So if we are taking the 4-hour time frame, then by the end of 4 hours, the open price of the next candle, or the open price of the next bar, this will represent the open price of the next bar. And since this was a bearish candle, you can see here, since this was a bearish candle, or at this particular point, the market was actually going down. So the closing price will instead be below. So the market opened here, went down and closed somewhere here, because this is the open price, this is the close price. And since the market opened and closed here, within this same period, we are taking the 4-hour time frame as an example. Within this same period, the market went up to this particular level. All right, then came down again to this particular level. So because in the forex market, the charts are always fluctuating, the price are always fluctuating. That is why you have the price where the market was open, you have the price where the market was closed. But in between the open and the closing time, you have a particular price that the market was able to go that particular high, and you have a particular price that the market was able to go that particular low. That is why here we have the market was open here and it was closed here. But in between this period, the market went up to, if this is maybe 1.4 or the exchange rate, the market went up to this particular level, and still between this period it went as low as this particular level, but it finally closed here. All right. The same thing goes for a bullish. If it is a bullish market or the market is actually going up, then the market opened instead here. So the market opened somewhere here. It went up to this particular level to form the high. That's why when we start going ahead, we start talking about higher highs, higher lows, higher highs, higher lows. So when we start going ahead, we'll be talking of things like that, because this is the dynamics that we'll be able to use to formulate those particular terminologies. So if it is a bullish market, then the market instead open here, went right up to this particular level where you have the high, then finally close here. All right. So if the open price is greater than if the open price is above, all right, if the open price is above the closing price, then obviously that is a bearish chart. And if the open price is below the closing price, then obviously that is a bullish chart, because the market open, let's just say here was 1.5 and close where? And close at 1.6. So from 1.5 to 1.6, so it was a bullish market. So that is a bullish candle. The price was actually going up. At the same level, this one opens at 1.6. I'm using the same level. At the same level, the bearish candle opens at 1.6, but finally closes at what? 1.5. So you see, it was instead going down because it moved from 1.6 to 1.5. But this one moves from 1.5 to 1.6. So that is just how you read a bar chart. That is how you read a bar chart. Because now you can see there are different bars. But I've taken out one bar to be able to explain to you what that bar represent. If it is a bearish candle or if it is a bearish bar, then that is what it represents. And if it is a bullish bar, then this is what it represents. All right. So with that being said, let's go to the next type, because this is the second type. That was the second type of price chart. The last and the most important and the highest used and the most popular price chart that you see in Forex trading, indices, stock, and whatsoever you're trading. The highest and the most used chart you see is what they call the candlestick chart. All right, the candlestick chart. The candlestick chart, they say candlestick chart shows the same price information as a bar chart, but in an easily readable format. That is the most important. In a what? In an easily readable format. Because with a candlestick, all the information, the same explanation I was using to explain the candlesticks is the same, to explain the bar chart is the same information I will use to explain the candlestick. But with the candlesticks, the information is very, very clear and it is easily readable. All right. So it is presented in an easily readable format. So for example, so that is the only distinction. That is the only distinction between a bar chart and a candlestick chart. All right. We started with a line chart. A line chart is just a normal representation of the price of a particular currency over a period of time. It doesn't show you the high, it doesn't show the close, it doesn't show the open, and it doesn't show the closing of that particular currency. Good. When it comes now to a bar chart now is the upgraded version, because it shows you the opening time of that market, it shows you the closing time, it shows you the high, and it shows you the low. So that is now, it gives you more information or detailed information. Now we are moving down to the candlestick. The candlestick now it has the same information as a bar chart, but in an easily readable format. That is the most important thing you have to be able to master when it comes to the three types of Forex chart. All right, because here, see the same explanation here. I already explained to you guys if you see a bar, because with the bar chart, instead of seeing this candle, the reason why this one is called a candlestick chart is because each of these, it is assumed that each of these represent candles. All right, each of these represent candles. So instead of calling it a bar chart, it is called a candlestick chart because each of these represent a candle. And the reason why it is called a candle is because anytime you see a candle is something like this, all right, with a small wick, So a candle is something like this with a wick. That is why all of this is called a candlestick, because this system, the bars all represent candles. Because here you also have wicks. You see, we also have wicks here. We also have wicks on this one. So that is why it is called a candlestick. But it has the same information. See the same explanation which I showed you guys on the bar chart. All right, this is the same explanation here, because here you can see. Let's just take this one now as the next time you see green on your chart, on your MT4 or your MT5. Any time you see, you can always, I've shown you guys how to set your bars, how to set your chart to have the green and the red candle. Anytime you see a green candle, it represents a bullish market. And anytime you see a red candle, it represents a bearish market or a falling market or a decreasing market. All right. So taking a bullish market for an example, you will see we have the same information here. We see the market opened somewhere here. You can see this is the open price. The open price was here, and this was the closing price. All right. From the open price to the closing price, you have what they call the body. You can see this one stands for the body of the candle. Just like I mentioned somewhere here, we have a candle like this. This is a candle like when you use a candle in your house. A candle is something like this. So from year to year is what they call the body of the candle. All right, this is the body of the candle, and this one is a wick. But in Forex, this wick represents the high or the low if we are talking about a bearish or a bullish market. All right. So here you see from year to year represent the body of the candle, and from year to year represent the high price. That's the highest price the market went before finally closing here. And this one represents the low price, which is the lowest price the market went before finally closing here. The same explanation goes for a bearish market, a bearish or a decreasing market. The market opened somewhere here. This was the open price. It came down and it closes somewhere here. So between year and year, this is the body of the candle. But before the market finally closes here, it went as low as this. So this is the low, the lower price. And before it finally closed here, it even went past the open price and came as high as this. And this is still the high price. So that is the same explanation. But now on the candlesticks, what has been added on this one is what they call the body of the candle. The body of the candle. Because when we start talking about the body of the candle, that is why we'll start talking about different candlesticks pattern or different types of candlesticks, where we start talking of double engulfing candles, double engulfing, the hanging man, or the morning star, because you might just have some candles like this. You might have some candles like this. And you might have some candles as long as this. So in Forex trading, all these candles represent something. You have this one that engulfs all of this is called a full engulfing candle. And this is a very big reversal sign. If you are trading Forex and on a key area, you have a candle as long as this, it means that is a key reversal signal, all right? So as we start going ahead, we'll start talking about the different types of candlesticks and how you can use candlesticks for trading. Come with me, see, let me show you something very interesting. I was explaining about candlesticks, and the chart we have here is a typical example of a candlestick chart, all right? So we have different candlesticks here. Each of these represent a candle. Each of these represent a candle. And each of these represent a particular period. So if we are taking the 4-hour time frame for an example, let's take this big, they used to call big ass candle. So let's take this big candle, all right? So since this candle was red, let's deduce the four most important thing. Let's deduce the opening price, the closing price, the high and the low, all right? So here we have, this was our open price. Then since the market came and closed somewhere here, this was our closing price. And you can see there's a small wick here. So this small wick represents the low of the market. And this small wick also up here represents the high of the market. All right? So those are the few most important things you need to be able to pick out if you are talking about a bearish candle. And the same thing goes here. If we are talking about this green one, which is a bullish candle, it means the market opened somewhere here. That was the market open. The market open was here. And the market closing was here, market closing. And in between this and this is the body of the candle. This is the body. All right, this will be the body of the candle, and this would be the higher price the market went, the higher price and the lower price. So that is how you are able to read any particular chart, or you are able to read candlesticks on any particular chart. And if we are talking of a 5-minute time frame, then this one will represent 5 minutes. Then this one will represent after every 5 minutes. One candle will be formed after every 5 minutes. If we are talking of a 4-hour time frame, then after every 4 hours, all right, after every 4 hours, you see one candle. After every 4 hours, after every 4 hours. So if we're talking about 4 hours, this one will represent 4 hours, 4 hours, 4 hours, 4 hours, 4 hours, 4 hours. If we're talking of 1 minute, 1 minute, you can actually see the movement, because each of these candles is just going to be formed for 1 minute. 1 minute time frame is going to be very rapid, all right? So if we're talking of 1 minute, then each of these candles will represent 1 minute. 1 minute. After every 1 minute, one candle will form and close. And before any candle closes, it will give you the 4 properties. The 4 properties of any candlestick, which will be the open price, the closing price, the high and the low price. That is no matter whatsoever you are trading in Forex or even in stocks, that is the same information you're going to be using. This is the same chart. We're just going to stick to candlestick chart, because from now to the end of the course, or from now to the end of your Forex career, we're going to be using candlesticks chart, because it's simple. A candlestick chart just encompasses every other type of chart. We've mentioned about a line chart, we've mentioned about a bar chart, and now a candlestick chart. So a candlestick chart just encompasses, it has all the properties of all the other types of chart, and this one even have more detailed information that other charts don't have. So from now onward, we're going to be using a candlestick chart. All right, so with that being said, let's see what we have here. Good, the way forward. So what is the way forward? This is very, very important. I brought this topic up because I don't want you to be confused. I want you to stay organized, all right? I don't want you to be confused. That is why I have the way forward. And when we come to the way forward, the first thing we have here, it says that the best way to go with trading is to keep your trading as simple as possible. You see, so the best way to go with trading is to keep your trading as simple as possible. This is very important, because sometimes the more information you put on your chart, the more indicators you put, the more RSI, MACD, stochastic pivot, the more things you put on your chart as a Forex trader, it's going to lead to misinformation paralysis. That means you're just going to be paralyzed. You're just going to be paralyzed with that information, and too much information instead paralyzes you. So sometimes you just have to obey what we call the KISS strategy. So that we just keep it simply stupid. All right, keep it simply stupid. Just keep your trading as simple as possible. And talking about keeping your trading as simple as possible, that's why I say too much information and indicators on your chart will instead paralyze you. As simple as that. So just stick to, I've already explained candlestick charts to you, and that is what we're going to be using from now onward. If it comes upon where you need an indicator, I'll tell you that basic indicator that you use. If you want to use maybe 1 indicator or 2 indicators, that's enough. But seeing somebody who is having 10 indicators, 15 indicators, this and that, one indicator will be telling you to buy, another indicator is telling you to sell, another indicator is telling you to move out of the market, another indicator is telling you to take profit. At the end of the day, trust me, you're just going to be paralyzed. You won't be able to make any decision. Keep your trading simple. Best advice I can give you today. All right. After having an idea about the different types of chart, the best chart to stick with is the candlestick chart. I have mentioned it over and over. So the best chart to stick with is what? A candlestick chart. And that is what we're going to be using on all our videos. That is what I've been using on all my videos. My live trade, even the ones I'm trading with $20,000 account, 50,000, making profit withdrawal, is with the same chart. Candlestick chart. All right, and then find a system. This one is very, 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 very important. We've already covered that. With this one, they say find a system and combination that works for you. That works for you. This is very, very important. Find a system and combination that works for you, because each trader chart combination and preferences is different from trader to trader. All right. My system of trading might not be the same as your system of trading. Your system of analysis might not be the same as my system of analysis. And my preferences of chart, maybe even though I'm recommending that you should stick with a candlestick chart, maybe your own preference is a line chart or a bar chart. Some people just like to do the opposite of things. So that is why I'm saying in Forex trading, do whatsoever is putting the money in your bank account. Do whatsoever is giving you the profit. If your own system, you prefer your own system, you prefer an indicator to another one, or you prefer a particular chart to another one, or you prefer a particular combination, or your preferences of Forex combination is different from another person's own. So do what works for you. All right. When I sit here sometime and I give you guys some recommendations. I'm giving you guys recommendations that have worked for me for years upon years upon years. Systems and recommendations that I was able to come up by myself, not copying from another person. When I started trading Forex, all the systems that I copied from people, I lose money through or using all those systems because they were not my own system. They were not part of, I didn't have a fee of it. I didn't understand what I was doing. So in Forex trading, do what works for you. Your own preference, your own system of trading might not be the same as my own system of trading. So even though I'm teaching you how to trade, it will become a point in time where you'll be able to develop your own system that you'll be the only person who can trade that system. You are the only person who can understand that system. All right. So do what works for you and stick with what put money in your bank account. So with that being said, I think we've come to the end of this video. If you've gotten some value so far to this particular point, as always, please leave a thumb up on the video. Leave as many thumb ups as possible, even though you can only leave one. So just leave a thumb up on the video. And if you are watching and you haven't subscribed, please hit the subscribe button below to subscribe to the channel, and also follow the playlist to be able to watch all the videos on that playlist. Until then, I'll see you guys on another video. Peace.